For Morningstar, I'm Jeremy Glazer. The New York City pension funds have announced that they're going to be divesting from fossil fuels. I'm here with John Hale. He's our Director of Sustainable Investing Research. We're going to see what this could mean for investors who are thinking about making an impact with their portfolios. John, thanks for joining me.
My pleasure.
So let's take a quick look at this announcement about this divestment from fossil fuels. Is this the continuation of a trend? We've seen a lot of pension funds take these kind of steps.
Definitely, we're seeing a lot of pension plans doing this, and if not going fully into divestment, there are some other areas that they are exploring as well, like sort of best-in-class investing, or just even engaging with the companies that they do own in their portfolios.
Let's take a look at some of these options. It could be illuminating for people who are thinking about their own portfolios. The first is a full divestment. What is the case that's being made to walk away from these companies?
Yeah, well, I think divestment, first of all, probably interesting to talk about divestment in kind of in terms of the criticism that is made about divestments, which is basically, that if you take something out of your portfolio for sort of non-investment related reasons, you risk, it's said underperformance. What it really is tracking error. You risk tracking error. You could underperform, you could outperform over time. And it was very interesting, I thought, that GMO recently came out with a quick study that they did where they took the S&P 500 and they took out a sector at a time and sort of looked at what the S&P 500, X energy looked like, X, financials, X healthcare. Went back 20 years, 50 years, 90 years. What they found really doesn't make a lot of difference in return. So, the primary case, I think, against divestment that, well, you're risking a lot of tracking error, not that big of a deal. But I think in addition to that, we've seen over the last few years an investment case developed for divestment, which is basically that your large fossil fuel companies, especially the major extractors of coal, oil, and natural gas, are companies that are going to find it much more costly to operate over the not too distant future. And so a divestment of fossil fuels really is saying we don't think these are great investments going forward. We have some evidence, certainly in the last few years, that that's been the case, despite the natural gas boom of the last few years. The MSCI All Country World Index ex fossil fuels has outperformed the base index over the last 7 years by about a percentage point annually.
Another option is just looking at best-in-class investments instead of saying, I'm not going to own fossil fuels, you own the least polluting or the ones that are the best stewards. Yeah. Why would people gravitate towards this option? Well,
best-in-class is really saying, we're not going to take out everybody. We're going to just sort of focus on those that in this sort of transition to a low-carbon economy are handling that better than their peers and are sort of improving their sustainability performance in areas like managing their carbon footprint, energy efficiency, maybe even investing in renewables. So that's definitely a way to go as well.
And then finally, there's engagement, and we hear a lot of this, particularly from the passive index providers who have to own everyone. What's the case for owning them, but then engaging with management to try to make a change?
Right. Well, engagement is having a seat at the table as a shareholder, and we're seeing quite a lot of action on that front recently in the engagement world. Just last year, for example, 63% of the shareholders of Exxon, including their largest fund company shareholders like BlackRock and Vanguard and State Street, all voted to encourage the company to release regular reports to investors about the risks they face from climate change. BlackRock just announced they were indeed going to do that just last month. In addition, there's a group of investors called the Climate 100 Task Force that have bound together this year and said, we're going to coordinate our engagements with the 100 companies that have the heaviest carbon footprint globally to talk to them about how to reduce that footprint and what their plans are for the future. So certainly engagement can be effective. I think tilting portfolios towards best in class can be effective, but so can fossil fuel divestment. They're not as mutually exclusive as they might seem. You can do sort of combinations of all three. And I think it's, investors have a choice here paths they want to take, and it's just really not that productive to say, oh, one's good, one's bad. I think they all can serve a purpose.
John, thanks for walking us through that today.
My pleasure.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.